Thank you so much, Denise, and thank you everybody for joining us today. We definitely appreciate you being here with us. So today we're going to be covering technical analysis, identifying chart patterns. Before we do that, we do have to cover some legal information. Any screenshots, charts, or company trading symbols mentioned are provided for illustrative purposes only and should not be considered an offer to sell, a solicitation of an offer to buy, or a recommendation for the security. Investing involves risk, including the risk of loss, and technical analysis focuses on market actions, specifically volume and price. Technical analysis is only one approach for analyzing stocks, and when considering what stocks to buy or sell, you should use the approach that you're most comfortable with. As with all your investments, you must make your own determination whether an investment in any particular security or securities is right for you based on your investment objectives, risk tolerance, and financial situation. Past performance is, of course, no guarantee of future results. Now, with that out of the way, let's go over what we're going to take a look at today. Colin?
All right, thanks everyone for coming out today, and we just want to let you know, as Denise previously mentioned, that this is the third part of a four-part series. Our previous parts that we've done was, the first one was building blocks, which was going over the fundamentals of technical analysis, which is, the second part was understanding technical indicators, which was covering some technical indicators of trend, momentum, volume, and support resistance. Now, these are actually available in our Learning Center under the Archive Webinar section on Fidelity.com. Today, we're going to be covering identifying chart patterns, and the fourth part of this series is going to be gaining confirmation and managing risk, which we hope that you can sign up for and join us on October 27th.
Yeah, and if you missed any of those other ones, I encourage you to take a look at them, especially if you're going to go to the fourth one, because the fourth one really is going to be tying together all three of the things that we've gone over. So it's going to give us a nice way to package the whole thing up at the end. So let's start talking about patterns. Well, before we can talk about patterns, we have to know the definition. What are patterns? Well, the simple definition is here. It has to be bounded by at least two trend lines. They can be straight or curved. And this is important because straight trend lines are what most people are familiar with, but you'll see that there are some patterns that use curved trend lines. And if you remember back to our earlier webinars, we were using SMAs to show trend lines or simple moving averages or exponential moving averages, and those are rarely perfectly straight as well, right? So be aware that it's not always going to be a perfectly straight line. The second point, I would argue, is the most important point. That is, the pattern is only complete on the breakout. This is very important, and I would even argue that it's not said pattern until you have that breakout. So oftentimes people will ask, is this a head and shoulders top? Well, we don't know. It's not a head and shoulders top until you've seen the breakout, okay? Until you've had that confirmation. And that's going to be very important. We're going to reiterate this many times throughout today's session because you have to wait for that breakout or else it's not a valid pattern. So this leads us to, what are some of the problems with patterns? Well, the rules are very loose, and you'll see we're going to give you the basic rules for all these patterns, but they're very loose. They're not real strict and tight, and it's like everything with technical analysis. A lot of it is art, some of it is science, but a lot of it is art, and a lot of it comes down to your own interpretation and your familiarity with a particular chart and the way it reacts. So bear in mind the rules are loose. Anticipation is going to be difficult. It's always one of the toughest parts. This goes back to point 2, right? You have to wait for the breakout before you can actually act on the pattern. And when we say anticipation is often difficult, one of the examples that we're going to use today and we're going to talk about is a head and shoulders pattern. I think that one is the most common one where it takes a long time for it to develop, and you can see the left shoulder develop. You can see the head develop. You can see the right shoulder start to develop, but it's still not the pattern, and oftentimes people won't be able to wait for that breakout, and they'll act upon it prematurely. So it can't stress...
Brian?
Yes.
Brian? Hi, it's Denise. Can you just give a real quick definition of breakout?
We actually are going to do a bit about what an actual breakout is in just a couple of slides, so we'll definitely cover that. I can explain it, but it'll be better with the slides so you can actually see it. One of the other things you have to be aware of is premature and false breakouts, and we're definitely going to cover that as well. And additionally, recognition bias. This is another issue that a lot of people have where we look for something and we have a desire to see it and we make it appear, right? We look for this particular pattern, and we will manipulate the way it looks till we get to that pattern. We can manipulate the lines, and we can manipulate the information to get it to show what we want to show. We always want to be very careful and very cognizant that that is a possibility, and try not to do that. So when we talk about trading patterns, what are some of the techniques to trading patterns, Colin?
Kind of sticking with that theme, once again, it's about identifying those breakouts for that confirmation, right? And then using entry stops and protective stops to help set up your trades, being aware of retracements, and realizing possible price targets kind of help me out with what to expect from the trade.
Right. A lot of these patterns that we're going to talk about, you can actually project price targets from the pattern itself, and we're definitely going to talk more about that with each pattern. But to answer, Denise, your question, let's talk about what is a breakout, because this is very important. We've said many times you have to wait for the breakout. So let's review what a breakout is. Now, we talked in the first webinar about a breakout, but let's go over what it looks like and what it is. I think the easiest way to understand the breakout is to look at the chart on the right-hand side of the slide here. You'll see, in this case, the price is moving upward in an uptrend, and it hits resistance. We've drawn a line there. That line represents resistance. If you remember from the first webinar, resistance is a spot where price has a hard time getting through. Okay, so in the past, we've seen evidence that price has had a hard time getting above that resistance level. We've drawn a line there, and in this example, it hits the resistance level, it drops back down. It turns around, it starts coming back up, and it hits that resistance line that second time. Once it passes through that resistance line, now we have what is called a breakout. Okay, so that is what we're talking about when we talk about breakouts. One of the important things to remember, and we've covered this a bit in the past as well, but I definitely want to refresh everyone's memory. When we talk about breakouts, different people will have different filters or different confirmations that they'll use to determine whether they believe something actually has broken out or not, because we will talk about false breakouts in a little bit. But some of the things that people will use is they'll look for a close to be above, the price to close above that breakout, or they might look for 2 days closes above that breakout for more confidence that the breakout is real. Sometimes people will use just a certain amount of time. Other people will use a percentage or a points number above the breakout before they really believe it and confirm it. Everybody's going to have different filters that they choose, and quite frankly, you'll probably have different filters that you'll use for different stocks based on, or different underlying based on what you've seen in the past from them. Some people will use volume, and we'll talk more about that. Some people will use volume as a confirmation for their breakout. They might look at the breakout, and if there's a lot or a high volume accompanying that breakout, they'll consider it to be more valid, or it'll have more weight within the evidence. And conversely, they may say if there is no volume on that breakout, they may aspire less confidence to that breakout being real. So when we talk about breakouts, let's talk a little bit about how you can use them with trading, just in general, Colin.
So we're going to take a way to actually set it up, and you'll notice here on the chart over to the right, we actually drew two trend lines. One of them is the actual trend line that we're looking to identify, and the other one that we're doing as resistance, okay? Now, you can actually set up a buy stop order to be able to enter into a long position when it goes through or breaks out of, first this trend line, which is an aggressive approach, or even this resistance line where, we're feeling much more conservative about it and we feel that's breaking out of that resistance line, a stronger confirmation. We can use our entry points above there to enter into that position. You just got to be careful of false breakouts, or if you enter it too early, and obviously a failure, which is something we're going to be covering very soon.
And one thing I would mention here, just to make sure everybody's clear, traditionally a buy stop would be a type of order that someone would place to protect them on a short position. It would buy the stock and cover their short position if a stock went above a certain price. But you can also use a buy stop as a way to enter once something goes above a certain price. So in Colin's example here, the more aggressive approach might be to look at that trend line. If you look at the sloping down line, that's the trend line that we've drawn. you might say, I'm going to place my stop right above that trend line so that I buy this stock once it breaks above that. Someone taking a slightly more conservative approach might say, okay, not only do I want to see it break the trend line, but I also want to see it break through that resistance line that I've drawn and place their buy stop above that. So that's a little bit more conservative, gives you more confidence that the breakout's real because now it's broken through a trend line and a resistance line, so there's more evidence to support it. So let's talk about the danger here, though. We've mentioned a couple times the concepts of false breakouts and failed breakouts. Once again, I think going to the chart is the best way to get a concept of this and understanding this. So when we look at the chart here that we have on the right, we'll see that we've got the price moving up in an uptrend. It hits that first line, that resistance line that we've drawn there. It comes back down. It starts forming a new trend. Now, we've drawn the trend line in there. It would have been hard to draw that right when it happened, right? Because you would have had to wait to see that there was more lines to touch. But it starts going back up, and once again, it hits that resistance and comes back down. And that's where the second piece of the touch comes to the trend line. So we said the breakout is not a breakout until it breaks above that resistance line, right? So we see that it does now. It gaps above the resistance line, so it's technically broken out. Now here is where different people would have different interpretations, right? Some people might filter this and say, I'm not calling this a real breakout until it's had 1, 2, or 3 closes above that line. Or they might be looking for volume. But what ends up happening, you do get 3 days closing above that, and that might have been a valid breakout for some people. But on that fourth candlestick there, you'll see it dramatically drops down, and it comes back, and where does it go? It goes right through. You can see it goes through that resistance level that we had. That is now a false breakout once it goes through that resistance level. Okay? So this is one of the things that we want to be cognizant of, is that we will see false breakouts. And we will see failed breakouts, which is the next thing we want to talk about. What is a failed breakout? Well, it was a false breakout when it came back to that resistance line. It becomes a failed breakout when it actually drops down and now is not only is below the resistance, but it has dropped down and it's broken through the trend line that we had drawn, right? You see that long candlestick breaking through all the way down? Now it's a failure. It's broken through resistance and it's broken through the trend line in the opposite direction. Okay, typically, when we talk about failed breakouts, the price typically moves less than 10%, and then it moves back into the pattern and then breaks out in the opposite direction. Now, that's more of a trader's rule of thumb. It's not always going to be exactly 10%, but that's something we usually look at, okay? And we think about, okay, if it's moved above that 10%, we're less worried that it's going to be a failed breakout, okay? So being cognizant of that, and everybody's going to be different. Different stocks are going to give you different levels that you want to use when we talk about whether it's a failed breakout or not. But the important thing here is not only to be aware that you can have a false breakout and a failed breakout, but to be able to react and to be able to adapt and change. And this can be very difficult for us as traders, right? Because we hate to be wrong. And if you change and adapt, you're essentially admitting that you're wrong. And that can be difficult for us, but we have to get over that, and we have to be able to take the evidence that's given to us and make our determination based on that evidence. So now if you've had that failed breakout, you may now not be bullish on this particular security anymore, and you may want to reassess and say, okay, maybe now I'm bearish, or maybe I'm neutral and I just want to get out. But if you are able to take all the information and assess it, that's going to help you in the long run. So with that, let's talk a little bit about how someone might take a look at this and change their assessment column.
So we're going to talk about implementing protective stops, which helps you protect the capital. It can help you determine the amount of capital that you want to put at risk before entry. So it's something you really want to assess before actually entering into the position. In using stops, really what it does is it allows you to place an order if you have a long position to sell out of the position should it come back down to this price level for you to exit. Some people will use things like percent of where it's currently trading, or the amount of points down certain price levels, or a lot of people will use how much money they are willing to lose on the trade. Other traders will use things like trend lines or support and resistance to actually identify the price levels that they want to enter their stops on to protect their positions. And it's usually much more preferable to use price action to determine these levels instead of just an arbitrary amount on the position itself.
And usually, we're talking right now, we're talking about risk management, right? We're talking about managing your risk. And a lot of times, when people first start using technical analysis, they'll use more of an arbitrary approach, like Colin said, where they'll say, okay, if it moves X percentage, then I want to get out. As you become more and more familiar with technical analysis and more comfortable using it, I think you'll find that a lot of people will gravitate toward using technical signals for their protective stops, where they might look at a trend line breakout or a support or a resistance level to set their stop levels. Not one way better than the other, just as you become more comfortable with technical analysis, you might find that occurs.
And you can also use things like trailing stops, which, let's say it does break out and you want to kind of protect the gains on the way up, and the first sign of trouble you want to exit, that's where a trailing stop, because you can do it by, whether it be by percentage or actual dollar amounts, to actually follow that price up. First sign of weakness or trouble, it gets you out of the position.
So let's talk a little bit more about this idea of changing. And I think that this next slide really does a great job of showing us exactly the mindset you would be in. And let's walk through this trade for you, Colin.
So we identified that this security has kind of walked right into and has found some resistance, right? So we've seen that uptrending stock has entered in and found resistance and has pulled back. Now it's also finding an area of support. So it's actually creating lower highs and higher lows, and it's creating this triangle. Now, triangle really doesn't have a directional bias. I guess we can find that it has a 50% chance of going up and down, but you know that it's going to move, and that's something that we'll be covering. So what you're looking for, you'll see here that it breaks above that upper bound trend line. Well, all right, we enter into a long position. We want to trade this breakout. Now we'll see that it actually reverses at this point. Upon entering this, we will set our stop order using the peak of that triangle to set that price level. And you'll see that it actually does pull back, which creates that false breakout because it breaks down below that upper trend line. What we've noticed is that not only did it go through our stop that we set at the peak, it's actually broken down the lower trend line as well. So now it's actually a failure, right? It's breaking out down below. So this allows us the ability, and we were talking earlier about changing your mindset and being ready to adapt. Now you reevaluate. Maybe this is an opportunity for a bearish trade on it now.
That's a great point. This is really where you adapt. Maybe at this point you've decided you're going to go short this particular stock because you had it in an uptrend. It's no longer in an uptrend. It's now moving down. This would be where you would want to be able to look at it again and reevaluate and see where you now have your position. So one of the things that we've talked about without mentioning it is something called a retracement. Okay? A retracement is very common, and once again, the easiest way to understand it is to look at the chart. If we look at this chart, you'll see we've drawn a trend line on the chart. You'll see that there's price action on the left-hand side, moving up and down, starts moving up, comes back down, and we see at the point that we've labeled trend line breakout, we've had our breakout. So the breakout has occurred, but what happens after that breakout, that trend breakout? Well, the stock moves down, but you'll notice that it turns around and it comes back up and it hits that trend line again. This is what's called a retracement. And then it turns around and it goes back and follows the path downward. Why is this important? Well, a couple things to remember here. One of the things we mentioned in the first webinar is that when you draw your trend lines, you extend them out into the future. This is a perfect example of why you would extend that trend line out to the future, right? If you had drawn this and you kept it going to the right, when this occurred, you would have looked at that trend line as an area of resistance, right? And it did turn into resistance in this case, right? Trend lines, once they're broken, if they were providing support, they tend to revert and become resistance once they've been broken. So that's a perfect example here in this. That's exactly what happened. Now, when we talk about retracements, there's two different types. So the first one is on a breakdown. So in our example here, the chart that you're looking at, that was a breakdown. It broke down below the trend line. And then it pulled back up. So it's a pullback. It pulled back up to the trend line before it resumed the trend back, the downtrend that had already started forming. Okay? The other type is on a break up. So now if you have resistance and the price breaks up through the resistance and it gets thrown back down to resistance, it's a throwback. Okay? So it's just the opposite. It's when you're in an uptrend and you get thrown back down to the resistance line before you resume that uptrend again. Be aware they don't always occur. They're fairly common. We've got a note here, performance can suffer when they do. In not all instances will it, but in some it will. Another way to look at this is the common way you've probably heard this. You've probably heard people say, I'm waiting for a pullback, or I'm waiting for a throwback to get in. This is exactly what people are referring to when they say things like that. They're talking about, I'm waiting for that second chance, right? So if we look at our example on the right, they might not have gone bearish when it first broke through that support level. But now they said, okay, I'm waiting for my pullback. They got their pullback. That's their second chance to get in and take advantage of that downtrend. Another thing to keep in mind when we talk about retracements is usually they're a third to a half of the original move. So if we look at the actual chart that we have here, it did essentially a half of the move, the original move from the peak down. If you see it go more than that, say 2/3 of the original move, that's a danger. That's a warning sign. It may not actually be a retracement. It might actually be the start of a new trend in the other direction. Okay, so just want to be aware of that. If it really is a retracement, it usually isn't going to be in that 2/3 or more. It might be time. That's a signal to you, okay, I have to reassess this. So when we talk about dangers, that's one danger. What are some of the other dangers in patterns, Colin?
We were mentioning before where we like simple solutions. Just as humans, that's what we want. So a lot of times we're going to see patterns that we're going to force patterns onto a chart, even though it may not be there. We want to see it so bad that we just project it on there instead of just allowing the chart to show us what a real pattern is, allow it to actually confirm.
Yeah, and really, it's that biggest bias. That's our biggest problem. Additionally, if you look at it from a perspective, as humans, we're terrible statisticians. We tend to believe market lore as opposed to actual statistical evidence, right? We see it all the time. People will talk about a particular pattern that they see or something emerging, and it's worked 100% of the time. Well, maybe that's because it's only happened one time in the past. Is that really enough evidence to base it on? Not necessarily. So just be aware of that. And we tend to see the future as past, right? We look at the past and say, oh, it's happened. This has happened in the past. It's going to happen in the future. It's not always the case. Things are always changing. And the last point I think that's important to remember here is don't stick with the original price target. It's not if things have changed, if evidence has presented itself, you don't have to stick. It's not set in stone. Reevaluate it, okay? There's a tendency where we say, okay, I've drawn a price target of X, and we don't get to X and we stick with it, but maybe the evidence is now telling us X is never going to happen. Don't be afraid to say, okay, I don't think X is going to happen anymore. Now I'm going to reevaluate and look at what are my other alternatives. So just a quick note before we actually get into the patterns section. We are going to now start showing you different patterns and discussing them. I just want to note that we will talk about degrees or levels of performance on all of the different patterns and how they typically have performed. That information, there's a note on the bottom of the slides that it comes from Kirkpatrick's Technical Analysis, the complete resource for financial market technicians. It's a very famous book for technical analysis, and the work that is in there is actually citing a lot of the work from Thomas Bulkowski's books, Encyclopedia of Chart Patterns and Trading Classic Chart Patterns. So that's where that information comes from. Thomas Bulkowski went back and back-tested and did all kinds of research into all the different patterns to get some statistical analysis behind how well the different patterns performed relative to each other, and we will talk about that as we go through. So let's talk about the different multi-bar patterns. The first patterns we're going to talk about today are considered multi-bar patterns because they're made up of more than one bar on the chart. So some of the ones we're going to talk about, these are really more of the common bar patterns that you've heard about. We're going to talk about some horizontal congestion type of patterns. Those are double tops, double bottoms, triple tops, triple bottoms. We're also going to talk about rectangles, which are also sideways or horizontal or congestion areas. Most of these patterns that we're going to be talking about, there are some form of consolidation, okay? Consolidation in the price action within the trend. The next area we're going to talk about triangle patterns. We're going to talk about symmetrical triangles, ascending and descending triangles, and wedges. And last but not least, we'll talk about head and shoulders and cup and handle. Many of these patterns, they are classified as either continuation or a reversal pattern, but keep in mind, they can always go either way, okay? So don't get set on something because it's generally considered a continuation or a reversal. It doesn't mean it's always going to be that. Another thing I would mention here, clearly this is not an exhaustive list of all the patterns in the world. These are probably the most common ones that you've heard of or that you will hear about within technical analysis world. Like Thomas Bulkowski's book, the Encyclopedia of Chart Patterns, he's got at least 58 different patterns that he looks there. So we're really covering just the most common, the ones that are the most frequently seen, the ones that have the most data behind how well they perform. So without further ado, let's talk about our first horizontal congestion pattern column.
One of the common ones is the double top. Now you'll see here with the chart over the right, we had a security that was trending up. And what it's done is it's found a resistance area. Okay, now it's pulled back from that resistance area. Well, when it pulled back, it also found a support area as well. Now that creates its peak. Now when it bounces off the support area, it creates the trough. Now these peaks and troughs don't have to be pointed. They could also be rounded as well. Now after it bounces off that support area, you'll notice that it comes back up and retests that resistance line. As we have it just laid out right here, we drew it out, that resistance line. Now that should be roughly the same price area. Once it comes back down, that confirmation is that when it gets down to that support line, the breakthrough is when it passes that support line. It goes right through that support area and then continues down. This actually has an above average performance. And to help you out with the price target, what you're looking for is you can measure the price difference between the peak and the trough. And then in this instance, in the chart that we're showing here, since it's breaking down, you take that breakout point and subtract out the point difference to give you a price target that you can use for your trades.
And this is a great example of what we've been talking about from the very first webinar in this series, is when you talk about technical analysis, there's part of it that's art and part of it that is science, right? If you look at this chart, it's not exactly the price points, right? There's some little spikes through it. This is why a lot of it comes from getting a feel for the charts and the particular chart you're looking at. Now, once again, I'm going to repeat it. This is not a double top until you have that breakout, right? Remember, it might look like a double top is forming, but it's not a double top until you have that breakout. And one other thing I would mention, you would want to really see this occurring after a trend up, right? Because you need a trend to reverse, because this is typically considered a reversal pattern. It's a reverse of the current trend. So you would want to see an uptrend to reverse before. So with that having been said, what's the other side of it with a downtrend? Well, if you have a downtrend coming into this type of a pattern, you'll have what's called a double bottom. So now just think of this as a double top flipped upside down, flipped on its head, so to speak. Now you have a trend down, it goes down, it hits a support line, and I'm just walking through what you're seeing on the chart on the right-hand side. I think it's the easiest way to get a feel for it. It breaks through that resistance line, it hits the support line, it bounces back up, it hits the resistance line again, falls back down to the support line, goes back up to the resistance line, but now this time it breaks through that resistance. Now you have a double bottom. So everything is the same as far as measuring goes to measure for your price target. You measure the difference between the peak and the trough, and you add it this time to your breakout point. That's your price target to the upside with this one. And remember, it doesn't have to be perfect peaks. A lot of times you'll find that it's a rounded bottom. If you look at the chart, the actual candlestick chart that we have there, it's a pretty sharp V on the left peak, on the left trough, but the right trough is more of a rounded trough. So you will see both. You'll see a combination of the two. But just remember, you really can't call it a double bottom until you've had that breakout. And what sometimes we'll see is this next slide is a perfect example of what might happen to a double bottom. Now, or a double top. So let's take a look at a double top that doesn't actually break out. Well, in this case, we have the trend going up on the left side of the chart, goes up through the support, hits resistance, comes down to the support level again, goes up to the resistance level, comes back down, but this time it doesn't break. It turns around and it goes back up to resistance, and then it comes back down to the support line, and then it breaks through. Now what do we have? Now we have a triple top, right? Now you can see that there's 3 peaks instead of the 2 before. This is a great example of why it's so important to wait for that breakout, because if you were acting on this before the breakout and you decided to go short, well, look what would have happened. It would have gone up. Eventually it did, but you don't know that it's going to form a triple top. It could form any number of other patterns. That's why you really want to look for that breakout. But once again, it's just like a double top, but you've got a third top added to it. If you look here, we did make a note that the best performance may be after a sustained advance. And this is very common because a sustained advance usually is going to take longer to shake out. And when I say shake out, for the direction to be determined, right? Shaking out the buyers or shaking out the sellers so that it either goes up or it goes down. And the longer it's been in that trend, it's going to take longer to shake those people out. That's why there's more indecision. That's why you have that triple peak, because it hasn't made up its mind, or the market has not made up its mind yet. And above average performance and an average failure rate. So it does have pretty good performance based on Bolkowski's back testing and an average failure rate. So remember what we talked about. What is a failure? Well, it's when it basically does the opposite of what you expected it to do. So let's talk about the other side of the triple top and talk about the triple bottom now.
So with the triple bottom, so you have a downtrend in security, right? You notice that it crosses through that resistance line there and has found some support. Now it bounces off that support, goes up to resistance. So it's just basically the triple top, but inverse. That's all it really is, and that's all we're really talking about here. And this is why confirmation, once again, we can't stress that enough, is so important here. Just like the double bottom, it wasn't able to break out. It actually went right back down, went down to that support line, but bounced off that support line again. It held, went through that resistance line, but on this third try, it busted through for a breakout. And that's really the characteristics with the triple bottoms, that it has the 3 troughs there and the 2 peaks.
And one thing I would definitely point out on this actual chart, the candlestick down below, if you'll notice, what is different about what we've seen so far on these charts? This time, the trend line on top is sloped. It's sloped downward. Now, when we talk about tops and bottoms, the important line to be horizontal is if it's a top, you want the top line to be horizontal. If it's a bottom, you want the bottom line to be horizontal. So in this case, we see that triple bottom, that's the horizontal line, right? The diagonal line is the trend line that we've drawn across those peaks. Now for some, that may be enough confirmation that it's broken out of that triple bottom. Someone being more conservative might actually draw a horizontal resistance line, and they might wait for it to break not only that downward trend line, but also through the resistance line. This goes back to that art and that interpretation when we look at charts. What are we, and how much risk do we want to take? The other thing I would mention, once again, it's the same with the triple bottom as with the triple top. It's best performance maybe after a sustained decline, right? So triple top, best performance after a sustained uptrend. On the other side of it, triple bottom, best performance after a sustained downtrend. Okay? Same reason, same rationale behind it. The longer it takes to get in there, the longer it's going to take to shake out.
Hey, Brian and Colin?
Yes.
I'm wondering, we have a lot of questions coming in where folks are wondering what time frames you are referring to with these types of analysis, and I'm wondering if you could just review that again.
Certainly.
About the time frames. Thanks.
Absolutely. So the short answer is technical analysis is fractal. What fractal means is what works on a monthly chart works on a daily chart, works on a minute chart. Okay, and it all will have the same implications. So any of these patterns can be found on a one-day chart, or they can be found on a 10-year chart. And that goes back to the fractal nature of technical analysis. Typically, when we talk about these more classic, well-known patterns, as I said, they can be found on any chart. But typically, people will be looking at these over usually days or weeks for the most part. And we are going to talk a little bit later on about some shorter patterns that are usually found more commonly on intraday charts. But these usually, people are going to be looking at them on daily or weekly charts. But in the truest sense of technical analysis, and due to that fractal nature, they can be on any time frame. And they'll have the exact same implications. So if you see a triple bottom intraday on a 1-minute chart, you would have to wait for that breakout. But once you get that breakout, your expectations could be the same as if you were looking at a monthly chart that it was going to now go in the other direction. So hopefully that clears that up for everybody. And we will talk in a little bit about some shorter time frame intraday types of patterns. But right now, let's continue with these longer patterns. So one of the next more common horizontal patterns is called a rectangle. And oftentimes we'll see this, people will call it sideways pattern or a consolidation pattern. They all mean the exact same thing. I know I call it consolidation all the time. Colin calls it sideways all the time. So it's the same thing, just different people will call it different things. And this is usually considered a continuation pattern. When I say continuation pattern, what that means is the trend that's in place before it comes into this pattern is typically going to continue out of it. But that's not always the case. In reality, when it's been back tested, it can go either way. Now, it does have a propensity to be a continuation pattern most of the time, but just bear in mind, it's not all of the time. And the key here, once again, is you're looking for that magic word. You're looking for that breakout. That's going to tell you which direction. Now, if you see, it often has many false breakouts. 75% of the breakouts are false. So this one, you really want to be conscientious of the fact that it does have a lot of false breakouts. So if you're watching it, you might want to have slightly tighter risk controls to make sure that the breakout is real. And also you want to remember with a rectangle, you need to have at least 2 lines touch 2 times. So that means essentially you need to have at least 4 reversal points, okay, before it's a rectangle. And this also goes back to looking at triple tops and triple bottoms and why you want to wait for that confirmation, because it could be just forming a rectangle. One of the other interesting things about rectangles is what we've labeled as a shortfall. And if you look at the drawn chart up above, you'll see it goes through, comes in, hits resistance, goes down to support, back up to resistance, down again to the support, back up to resistance, and then it goes down to what we've labeled a shortfall. What is a shortfall? Well, a shortfall is where you may have been expecting the sellers in this case to come in and push that price back down to support. But when you see a shortfall, that many times will indicate that the sellers didn't have as much conviction or as much momentum to push it all the way down that they had in the past. That can sometimes give you an indication as to what side is going to be the breakout. So in this example, the sellers couldn't push the price down to the support, and what happened? It turned around midway and came back up, and then it did break out to the upside. So it did, in fact, become a continuation pattern. So keep in mind that shortfall, it gives you an indication, but it's not 100%. It's not always going to break out to the shortfall, and you might see multiple shortfalls before you actually see a breakout. As far as when we look at these and how do we measure our price target, well, if we're looking at a support and resistance, because really with the rectangle you're going to have support and resistance because there's going to be two horizontal lines that are binding this. Measure the distance between the two. Once it breaks out, you add it or subtract it to that side. So if it breaks out to the upside, you would add that difference, and that would be your price target. If it breaks to the downside, you would subtract it down that difference, and that would be your target to the downside. From the back testing, the best occurrence is bottom breaking upward. So when you see this forming after a downtrend and it breaks out to the upside, that's your best occurrence. So we've talked about so far all patterns that are essentially horizontal patterns. What do we get when we don't have a horizontal pattern? Well, oftentimes we'll have patterns that are labeled as triangles. Let's talk about some of the more common triangles. Colin, why don't you get us started with, what is a symmetrical triangle?
So a triangle is where, in this example, we're showing an uptrending stock, and it's moved up and found some resistance. Now it pulls back off that resistance, and while it pulled back, it found an area of support as well. Now you'll notice that while within this pattern, you'll see that it creates lower highs and starts creating higher lows. Now, typically you'll see volume contract while within this pattern, and it actually creates a downward sloping upper trend line and creates a upward sloping lower trend line. And once again, we're looking for breakouts. And we mentioned before in our previous example when we were talking about protective stops and using those in the example, we brought up a triangle. It has a 50% in either direction. So we just know that it is going to move. So when it does create that breakout, you want to wait for that confirmation before placing whatever direction in this example to the upside, so we went long. And once again, you'll see here that it does have a throwback to test back down on that trend line, and then does continue on its way. To really give yourself a price target on this, what you can do is the price target is a line parallel to the opposite bound from the first reversal point. Now, another way that you can use it is actually using the distance of where it creates from the first reversal point to where it entered into the pattern.
So when we look at this chart, and a lot of people will use the parallel line technique. I find it hard to do, so I personally will use the second method. I will look at that triangle that you will see on the candlestick chart there, and on the left-hand side, that long vertical line making up the base of the triangle, I'll just measure that base and use that as my projected price target to the upside or the downside once it's broken out.
It really has a best occurrence is on an upward breakout, and it's really above average for all patterns. It does have many false breakouts, and obviously has moderately successful in performance.
One other thing I would mention with triangles, we said we'd talk a little bit, sometimes you can use volume. A lot of times when we see triangles forming, one of the things that you'll see is volume is contracting as the triangle is forming. So it makes sense, right? The volatility is contracting and the volume is contracting as well. Anybody that looks at the chart lately and looks at the S&P 500, you might be able to see a pretty good example of a triangle. We'll bring it up later and we'll show it in the live demonstration. So what's another type of triangle? Well, the symmetrical is probably the most common. It's probably the easiest to identify on a chart for most people. But we also have what's called an ascending triangle. Now, the main difference that you'll see here is in the last triangle, the symmetrical triangle, we had two sloping lines. We had a line sloping down from the top and a line sloping up from the bottom, forming our triangle. With an ascending triangle, we have a flat or horizontal line across the top and only one sloping line on the bottom. Okay? So usually when we look at something like a ascending triangle, we're going to be looking at the top line being a resistance line, okay, where we've identified resistance. That's our horizontal line, and we draw a trend line up across the bottom of the troughs to make our triangle. So if you look, you'll see the exact same thing here on the right-hand side, but now we have that blue trend line drawn diagonally up. So with this triangle, it's the same. It can break either way, but one thing about the ascending triangle that's of particular note is that 77% of the time, it'll break to the upside. So it's much more common that it will break to the upside. More than 2/3 of the time, it's going to break to the upside. That doesn't mean it's always going to happen. So bear that in mind. It doesn't always happen, but oftentimes the horizontal or the flat line is the line that it's going to break through. It's going to break up through that. Now, same thing for drawing a target. You can draw your target by drawing a parallel line, so a line parallel to your trend line based on the distance between your two reversal points, or you can just measure the base of the triangle, which once again is on the left-hand side. When you look at the triangle, call that the base, that vertical line. Measure that and use that to project upward or downward from your breakout point. As far as performance goes, breakouts usually occur 61% of the time in the pattern, about average failure rates, but there are many small false breakouts. And that's one thing you want to definitely be conscientious is a lot of times, we've said 77% of the time it's going to break up above that horizontal line, but you really want to make sure that you have some confirmation that it is a true breakout, because you will very often see some small false breakouts. Post-breakout performance average on upside, but above average on downside, which is interesting because a lot of times we said it's going to break to the upside, but it doesn't have actually as good of performance as when it breaks to the downside. So once again, this is why it's so important to wait for confirmation, wait for that breakout, because it might actually have a better opportunity if you waited and it breaks to the downside as opposed to the upside that you most likely were expecting. So once again, can't stress enough confirmation. Now, what if you see the opposite? Well, that's called a descending triangle. Colin, why don't you talk to us about the descending triangle?
So you'll see here on the chart on the right-hand side is that it found that resistance line, pulled back, and found the support line. Well, the support line, you'll see, is actually the horizontal piece of this, just the inverse of what we were talking before with the ascending. And you'll notice that it actually is creating lower highs, which is creating a sloping trend line, downward sloping. Now, once again, it can break in either direction. But it's most commonly it's going to break downward roughly about 64% of the time. And you notice here that it has an above average performance on an upside break. But the retracements actually occur more than 50% of the time on this particular pattern.
And remember, once again, you can use the base, the left-hand side of the triangle, to actually figure out your price target. So There's one last type of triangle that we want to talk about, and that's called a wedge. I know for me, this is one of the more difficult ones, so a lot of people might have a difficult time with this one, or maybe you're all much smarter than me and you won't. But with this one, you don't see it as common. It's not as common to find a wedge, and when you do, it's usually going to be after a big market top or a bubble, or on the other hand, at the bottom following a panic. Okay, it's usually going to happen after a longer, bigger type of event. So, that crazy euphoria that creates a bubble, or that panic that creates a panic selling. That's typically when you're going to see the wedge. What's the difference with the wedge from all the triangles that we've talked about so far? The main difference is that both lines are sloping in one direction. So our declining wedge, both of them are going to be sloping down. So our upper boundary or our resistance level is going to be sloping downward. Also, our lower boundary or our support level is going to be sloping downward. On the other hand, when we have a rising wedge, both of those lines are going to be sloping upward. So if we look at the examples that we have here on the charts, those are both rising wedges, and you'll notice that both of those lines are sloping upward. One of the things to remember with a rising or a declining wedge is that it has to touch at least 5 times the lines that you've drawn. And it has to touch one of the lines at least 3 times and the other line at least 2 times. And we've noted that on here because it is important. And the performance in both types is below average, and retracements are very common. So one of the things I would mention about this, and we've said that technical analysis is fractal, and you can see these on 1 minute, 1 hour, 10-week charts. It's all fractal. But typically when we talk about wedges, it's more of a longer term pattern that has occurred after usually some really big event. It's also one of the other things that is interesting about this pattern is it's one of the few patterns that could actually be considered a consolidation against the prevailing trend. So it's one of the few that actually exhibits that. And from a volume perspective, you should also see declining volume in the early part of the formation, and that is where we're looking. You see all of this volatility, and it starts to decline with the volume. And as far as a target goes for this, your target's going to be past your first reversal point. So in the other direction from, if you look at where we came into it, you want to go past where we came into it, okay? And that's going to be your price target. So let's talk about our next pattern, which is probably the most well-known, the most common, the one that you hear about in the financial news and people talk about most frequently. Colin, why don't you talk to us about the head and shoulders top?
Sure. So we're looking at a security that's been trending up. It is entered in here, and you'll notice that it actually has hit a resistance area where it's actually reversed, okay? And this is what's going to create the first peak of a head and shoulders top. Now it's going to pull back down, it's going to find some support, and then head back up past the peak of that left shoulder, which is going to create the head, which is a higher peak, finds resistance there, pulls back down. Now you'll notice that it's going to hit that same support level, okay, creating a neckline. At that point, it's going to follow up. Now, you'll notice that the volume is going to be heaviest in either the left shoulder or the head. Now, it's going to create that right shoulder. Now, once again, the peaks don't have to be pointed. They can be rounded. Now, once it finds resistance with that right shoulder, it's going to pull back. Now, this is the most important part. It needs to break through that neckline for confirmation. Now, you heard Brian earlier discuss about one of the most common dangers with the head and shoulders is identifying it early and not waiting for confirmation. Your confirmation is when it breaks through that neckline to continue and to break out on that. So you want to be very careful with that. Now, a way to give yourself a price target is by going from the head down to the neckline. In that difference of price, you want to, in this scenario, subtract that off of the breakout. And that will give you an idea of what the price target to use on that. And when it is confirmed, it is actually a top performer. And as well, you just, the neckline doesn't necessarily have to be horizontal. It actually can be in a trending up or down.
It can be sloping.
It can be sloping.
Head to the other. Colin mentioned that this actually is an excellent performer, and in Balkowski's back testing, it was actually number 1 for a top. So this was the best performing of the of the patterns that he tested for tops. With that having been said, it is probably the one that we commonly hear about, commonly see. It's also probably the most dangerous because of that, and because of the fact that you can see this forming, you can watch it forming, and people so frequently will jump the gun and try to get in before everybody else on that right shoulder, and it just never pans out and it doesn't turn into, right? We didn't get the confirmation, we didn't get the breakout, so it never turns into a head and shoulders pattern. What's interesting about this as well is when you get a busted pattern, and by busted pattern we mean it's basically a failed pattern. It didn't happen the way we were expecting. And when that happens, if the price rallies back up above that head, it's actually even more profitable in back testing. Doesn't happen very often, only happens about 25% of the time, but this just goes to that point about waiting for confirmation, because this could really have hurt you if it turns around and went in the other direction. That better performance, well, if you had acted too early, it's going to really hurt you. So you may have noticed by now that a lot of these patterns have the inverse pattern. So with a head and shoulders, we have the exact same thing. We have a head and shoulders bottom. And what is it? Well, it's literally a head and shoulders pattern turned on its head. Makes me laugh whenever I think about that, because it literally is. Now the head's at the bottom. But it has all the exact same characteristics. You use the exact same measurements. It's typically not quite as profitable as a head and shoulders top when it was back tested. But it has a low failure rate, so it's pretty reliable. I think it was number 7 in Balkowski's tests for bottoms. But just remember, it's the exact same thing, just flipped upside down. From a volume perspective, it's the same. Typically, you have the highest volume on that left shoulder, maybe a little bit less in the head, and then typically less on that right shoulder. These are, once again, when we talk about it's not always going to be that way, but that's the most common. So the next one we want to talk about is called the cup and handle. Anybody who reads Investors Business or used to read Investors Business Daily might be familiar. Bill O'Neill, he really popularized the cup and handle. Some people will call it a saucer, and I think that this one has so much popularity because of Bill O'Neill, but also it's fairly easy for a lot of people to identify this on a chart because it looks like a cup with a handle. The cup's the easy part for most people. And let's look at this chart here. What does it look like? Well, you have your entry point, which is called the lip, and I'm looking at the actual candlestick chart. And it hits resistance at that lip. And then you'll see it drops down, and it forms that rounded bottom before it comes back up to that same resistance level, which is also the lip. Now it's the lip on the right side, and then it drops back down shortly before it turns around and moves back up and breaks out above the resistance. That's when it becomes a cup and handle, when it breaks out above the resistance. Above the lip. It's not super common to see. It has average performance, but I think a lot of people can identify it when they see it because it really usually looks a lot like a cup. One of the problems with it is that it has actually a lot of throwbacks. It's very common to have throwback, which ends up looking like a second handle, sometimes even a bigger handle. Unfortunately, with this one, we don't have a way to measure price target. There's no measuring for price targets on this. So let's talk just briefly about when we look at a chart, how we're trading using these patterns. So let's take a quick look at a chart and see how you'd walk through this.
This is just kind of illustrate how you can adjust with the current market conditions and different patterns that present themselves. And you'll see here that with each opportunity and each pattern, we find our breakout points to be able to, whether it's enter in long or short, we enter in those positions and adjust protective stops along the way. And with each pattern that comes in, we adjust each target area, each buying opportunity, each exiting opportunity or selling opportunity, all the way up.
Yeah, and if you were doing this, I mean, you would get stopped out at the end, right? At the end of that last wedge, that's where you got stopped out. But this worked out well for you. If you got in at let's call it $103, and you got stopped out at $195, that's a pretty good trade, right? And this goes to our discussion earlier about adapting, right? You got stopped out there, but if you look at the chart, it started moving back up again. This is the perfect opportunity for you to reevaluate. Your trade is over. Now take a look at the technicals and decide, is it something you want to continue with? Do you think it's going to continue to go up, or now have you changed your viewpoint?
And it's a good example of using trend lines to help you set certain stop loss to help you out with mitigating that risk. So next, let's take a look at some candlestick patterns here to kind of supplement along with our chart patterns that we have in there.
And this goes to the earlier question about time frames. These candlestick patterns are going to be 1 or 2, and they're usually 1 to 5 bar patterns that occur over 1 to 5 days. They're usually on a daily chart. So let's talk about what some of these most common candlesticks are and what we're going to look at today. We're going to look at dojis, haramis, hammers, hanging mans, shooting stars, inverted hammers, engulfing, dark clouds, and piercing lines. And we'll go into more detail about each of those. But these are going to be more of they actually happen in 1 or 2 bars for the ones we talk about today. But one of the things to keep in mind with these is that oftentimes when people use these candlesticks, they forget that you want to see a trend coming into them. With candlesticks, especially with these particular chart patterns, you really want to see a longer-term trend because they're usually looked at as reversals. So you need to have a trend to reverse. If you don't have the trend, then you're not reversing anything. So really keep that in mind when you take a look at these. You really want to take a look at the bigger picture and remember that these are typically going to be used for reversals. So let's talk about the most common, the one most people know about if they know anything about candlesticks, the doji.
So the doji is a one candlestick pattern formed with the open and close are around the same price, and the high and low are roughly equidistant from the open and close. Now, this is something that you'll see very common on charts. It does indicate indecision in the marketplace, and also is possible warning sign of price change, especially when we mention that about a trending security. That's really what comes in, because if it's in a sideways market, it's really going to be much more insignificant in that kind of environment.
And it just looks like a big plus sign.
Right.
And it does indicate indecision because it opens and closes at the same spot and has some movement. So the next pattern we'll talk about is a harami. This one now includes 2 candlesticks. Okay, you can have a harami top and a harami bottom, and that's really dictated by what the first candlestick's color is. So remember, you can have candlesticks that are either filled or unfilled, or they can be colored red or green. Here, the unfilled one, the white one, so to speak, would correspond to a green, and the black would correspond to a red candle. So what you're looking for is that first candle. So on the top, you're looking for that first candle to be fully encompassing the entire range of the next candle. Okay, so if it's a harami top, you're going to have an up day. That's why the candle is clear or white or green. And then the next day has to be a down day. And the entire candle from that second day has to fit within the body of the day preceding it. Okay, so if you look at our example here, you'll see the entire candle fits within the day preceding's candlestick. Now for a bottom, it's the opposite. It's going to be a down day that fully engulfs the candlestick that comes after it, which is going to be an up day. So if you look at our example here, you'll see the black candlestick is our down day, and that candlestick body fully encompasses the entire candle up day next to it. That particular candlestick, that second one, that's called a spinning top. Okay, it's similar to a doji, it just has a wider body, meaning that the close was further away from the open. It wasn't almost the exact same thing. People commonly believe these are reversal patterns, but backtesting has shown that often can break either way. But we definitely wanted to make sure you know what the pattern is. So the next one also has some colorful names and may have heard of them, is hanging mans and hammers.
So these are one candlestick pattern differentiated by the actual color of the body. Each pattern has a high that coincides with either the opening or closing price. So you'll show here on the top there the hanging man. What it is, it opened up at the high range of the candlestick. Obviously, there's a wide range there that really creates a wick, but it actually closed on the upper end of that candlestick, which creates that the darkened body there. While the hammer is usually on the bottom, where you'll see that it opened on the upper edge of that candlestick. Obviously, once again, that big range, but it actually closed on the high end of that candlestick. Now, the hanging man, which is thought to be a continuation pattern, actually breaks in either direction randomly. It does have a slight upward bias. Its overall performance is below average, and hammers actually occur relatively frequently, but has a below average performance.
So the next two that we want to talk about are really, once again, just the inversion, right? The shooting star and the inverted hammer. It's just what Colin just showed us, upside down. Okay, so the shooting star, once again, it's one candlestick, and it's a down day, but it has a pretty small body, so the open and close are relatively close, but it had a lot of volatility or a lot of trading range within that day, giving you that longer wick, but it closed at the lower end. Okay, so it's showing you that there was volatility, but at the end of the day, it came and closed pretty close to where it started. On the other hand, you have what's called an inverted hammer. And with the inverted hammer, it's an up day, okay? It had a lot of volatility. It went up high, but it came back down to close near the open, but it still closed as an up day. Both of these, they're one thing that you'll see. They're fairly common. You'll see them very frequently on charts. And once again, average performance for these being a reversal.
The next one we have is the engulfing candlesticks. These are two bar patterns in which the second bar body completely engulfs the first bar body. Now you'll see the top one here. You'll see that we had a green candlestick or a white candlestick that we're showing here, a clear, where the whole body of this one was actually in the second day. It opened up high, sold off, and then closed on the lower part of the candlestick, and that body actually covers the whole amount of the preceding day's body. And you'll see the bottom is just the opposite, right? It opened up and then sold off for that day, so the body is a red or dark candlestick, while the next day it opened up lower, closed at the higher end of that candlestick, which is more than it actually engulfed the previous days. And it has a potential for excellent short-term performance on a downward breakout for the top engulfing pattern, but very poor results on an upward breakout. Now, the bottom engulfing pattern is thought to be an upward reversal pattern, but actually has very good performance on a downward breakout and a downward trend.
And one of the other things you might have noticed is that essentially the engulfing pattern is just the opposite of the harami that we went over earlier. So let's take a look at our last two candlestick patterns, dark cloud cover and piercing line. So the first one, the dark cloud cover, creatively named, it's easy to remember, I think, because it's putting a dark cloud over your trend. If we look at that candlestick, the candlestick on the left, it's an up day. And then you have the next candlestick is a dark cloud hanging over it. You have now a down day. Now, the important thing to remember, for me, this one's easy to remember because it's a dark cloud hanging over your trend. You want to also bear in mind the second bar has to close higher than the first and is black versus white, okay, meaning that it was down versus up. And it's just the opposite for the bottom, or a piercing line. Now you've got a down day, and then follow that with an up day. And you want to make sure that the piercing line is the opposite of the dark cloud cover in that the second bar is white, meaning an up day, and lower than the first bar, which is black. So you want to have it actually, even though it's up, it still doesn't go up above the entire down day. Dark cloud is thought to be a downward reversing pattern, and the piercing line upward reversing pattern. Not real great data on whether they're average, basically, as far as indicative going forward. Going back to the idea of different time periods, we're going to cover a few that are really more geared towards short-term trading. Those are pennants and flags, gaps, and pipe bottoms and narrow range. So the first one is a pennant or a flag. And these are essentially very similar patterns. And what happens is what you're looking for is a big up day. So in an up day or within a day, because these are shorter term, you'll see these a lot on an intraday chart. But you'll, in the day, maybe have a big uptrend, but it stalls. And it starts to come down. And when it has that slight retracement, that will determine whether it's a flag or a pennant. If it's a flag, it'll be two horizontal lines parallel to each other. Maybe not horizontal, slightly sloping down usually, but they'll form like support and resistance for that short area. And once it breaks, it usually will break as a continuation. So meaning if you come in hard, it's going to go out hard. There is a measuring tool that you can use. Basically, you use what's called the flagpole, or the candles or the bars that precede that formation. So when you are looking at that sharp uptrend, you measure it, and that's your projection to the upside of the breakout. It's the same for the pennant as it is for the flag, measuring-wise, same implications. The difference is that the pennant looks more like a triangle. Another common thing, this is probably one of those things that everybody's heard of, and that's a gap. So let's talk a little bit about gaps, Colin.
So gaps really are, there's no trading at specified prices between where a previous candlestick is closed and where the next one opened up. So there's a significant move up or down difference between the candlesticks. So on candlestick charts, it's actually referred to as a window. And they're caused by, appreciable change in supply and demand between the close and the open.
They're really emotional usually, right? It's usually a big reaction to enthusiasm or to panic. Either, really good or really bad news came out overnight. That's typically where gaps come from. As far as trading gaps, there is a system that we've detailed here. And in the interest of time, I'm going to move forward a little bit, and I would encourage you to download the slides and read it. But essentially the idea is really when you have a gap, if you're going to be trading it, you want to be very cognizant of the fact that gaps tend to fill themselves. The market hates a void. And they may not always be a real move. And there's a nice system right here that we've outlined that you can use to actually create a trading system around gaps. But I would definitely just always caution you with gaps to be aware of the fact that they are not always going to continue to go in that direction that they've gapped in.
The next we're going to look at is the pipe bottom or two-bar reversal bottom. Now you'll see that it has two bars and occurs at the end of a large trend, up or down. Ideally, the first bar in a bottom pattern closes at the low, and the second bar closes in the upper half of the range. Now, it's more reliable when you're using it with weekly data. And the bar ranges are larger than the preceding bar ranges. And really, the action occurs, once again, on breakout through the second bar.
And remember, with this we're actually looking at an open high, low close, or on a bar chart. That's where you're going to find this particular pattern. Volatility patterns. So here we're looking at what's called, on a bar chart, an inside day. It's similar to a harami if you're using candlesticks. What are we trying to show you here? Well, we're showing you low volatility. What is volatility? What we said in the very first webinar, a reason why candlesticks and open high low close have become so popular is because they give you an idea about volatility. And typically we see low volatility at the beginning of trends, okay? So new trends often begin from periods of low volatility. So that's one of the reasons why people like those two particular types of chart. It's very easy to see if volatility is expanding or contracting. If volatility is expanding, you'll see the bars getting longer. If volatility is contracting, you'll see the bars getting smaller. Okay? And when we look at this on the right-hand side, it's called an inside day because the second bar completely fits within the bar preceding it, just like the harami on the candlestick chart.
So the next one is narrow range. And really we're talking about one low volatility pattern. It's called the narrow range pattern. This is where the bars with a range narrower than its preceding bars. You'll see over here on the chart to the right where you'll see that this bar is volatility. The range on is a much less than the previous 3 days bars. The breakout occurs on the break above or below the higher low of the narrow range bar.
So we talked a little bit about there was statistical analysis, back testing done on all these patterns. Just to sum it up for you, the best multi-bar patterns in upward signals have been descending triangle with a breakout to the upside, a rectangle with a breakout to the upside, and the pipe bottom that Colin just discussed with a breakout to the upside.
So how about in declining markets? Well, that's where a flag, where it has a breakout to the downside, a head and shoulders top that has a breakout to the downside, and an island reversal, which is when we talk about the gaps, it gaps up, has some price action within there, and then gaps back down. That's what creates what's an island by itself, right? So that's an island reversal, and then it breaks down.
And it looks literally like an island by itself on the chart. So just to summarize today, a couple things to remember. The rules for these are always going to be somewhat loose. Waiting for confirmation is hugely important. Always wait for that confirmation. And be aware that you can have false breakouts and you can even have failures, and be prepared to change your opinion or to change your outlook based on the evidence that's being presented to you by the chart. So just want to reiterate one last time, we do have the fourth part in this series coming up, and that's going to be on October 27th. And of course, you can always go to the Learning Center to learn more about technical analysis. And now we want to take a moment to give you some live demonstrations, take a look at some of this actually on Active Trader Pro. And Colin's going to bring this up. And I said earlier, anybody who watches the S&P 500, you might have seen a triangle forming. You might have even heard about it in the news. If you can see the chart right now, look at the right-hand side of that chart. What do we see there? Well, we see a triangle starting to form, right? Colin, why don't we go ahead and just show how you can draw some trend lines on there to identify that triangle. So right now Colin's drawing the top of the triangle. So it's interesting because some people might look at this and see yesterday it actually broke above it, right? But depending on how you filter it, you may say, well, I need 2 closes for it to actually be above that trend line, or maybe you need 3 closes. So it really is going to be a good point about why you need to set what you have for various filters to determine whether it's a real breakout or not. And here we'll put the downward part on here. One of the nice things that you can do is you can draw your line, get your points, and you can actually just right-click it, left-click it, and then click on the box that says Extend Right, and it draws it for you. So now, if you're looking at the chart, you can see we have that triangle forming there. And what we've learned today tells us that this could break either way. We're looking for confirmation. Right now, we see that there is some activity to the upside, but we may be looking for more confirmation. We may be looking for multiple closes above it. We might be looking more from, is there higher volume, is there lower volume, are we seeing momentum? And this comes into when we talked about all the different indicators you could use. This is where, now that you've got your chart, you've got your price action, you're seeing your pattern on there, now you can use other tools to confirm it. You can take a look at, well, what is volume doing? Is that confirming it? What is momentum doing it? Is that confirming it? One of the other nice tools that I'd like to bring up here in Active Trader, if you click on technical analysis, you can go to patterns and events, and we have Retracements software that will actually go out and run in the background and look for patterns and events on the chart for you. So if you're new to technical analysis, this could be extremely handy, right? So let's see, what did we get here? Now we see this panel has come up at the bottom. Well, we see these little icons here. They tell us what the pattern is that has been identified. So here it's identified a symmetrical continuation triangle, and it tells you whether it's bullish or bearish. In this case, it's saying bearish, short-term bearish, and we can actually have it added right to the chart. And click on Add to Chart, and it's adding it pretty much the same as what we just drew, right? The lines here, they're showing you, this is the trend down, because it's in a downtrend, and then they've drawn this line here for the top of the triangle, and then this line here for the bottom of the triangle. Now, what's interesting about this is the computer that drew this, right? Now, you could have two people that study technical analysis look at this and draw each or either of those. It comes down to that art aspect of it. It comes down to the interpretation part of it. And another thing that I think is really nice about this is if there is a pattern that you don't know about and you see it pop up, you can click on View More Information, and it'll tell you more about that pattern, its implications, what it gives for a price target, if it has a price target, and you can even learn more about it if you'd like. So one last thing I want to make sure we get a moment to show here is on Fidelity.com, if you go to Research and then Stocks, it'll bring up the Stock Research page. And if you scroll down on this page, you'll notice that you have this technical events. This is provided by Retracements again, and it will show you various technical events that have been identified by running these technical analysis scans across the markets. So in this case, there was a continuation diamond, and it shows you right there what the continuation diamond looks like. Or here, let's look at everybody's favorite. It found a head and shoulders bottom, right? So if you click on this, it'll give you even more information about it, and it'll show you where it found it, how it found it, and it'll draw it on the chart for you. So I think this is a great tool. Definitely, if you're just starting to use technical analysis, it's great because you can actually use it for confirmation as an extra bit of confirmation. If you think you see something and you go here and you see, oh, they've identified the same thing that I identified, it'll give you more confidence. So I want to take a few minutes here to make sure that we get some questions in. So Denise, is there some recurring themes or questions that we've had coming up?
There is one. Can you repeat the authors and names of books that would be helpful for folks? Some people had missed that information at the beginning.
Okay, absolutely. The first one is by Kirkpatrick. Last name's Kirkpatrick, and the book is called Technical Analysis. I actually have it written down, the complete name. Technical Analysis, the complete resource for financial market technicians. And that was written by Charles Kirkpatrick. Very, very common book for technical analysis. A lot of people use it. And a lot of the information on the patterns and the patterns statistical reliability was provided from books by Thomas Bulkulski. And those two books are the Encyclopedia of Chart Patterns and the Trader's Guide to Chart Patterns.
Super, thank you. Another question for you. Is it okay to base someone's buy and sell decisions on these patterns alone, or is there something else that they should be looking for as well?
Yeah, that is an excellent question. We always would like to say that you should never do something based on one piece of evidence when it comes to trading. And this is a perfect example of that. The pattern itself always needs to have some confirmation. It's not just the breakout, because as we said earlier, you have things like false breakouts and failed breakouts, and patterns fail. Patterns don't develop all the time. That's where you want to find the supporting evidence. It's just like I was saying a moment ago. That's where you want to start taking a look at your indicators. You want to look and see, is the preponderance of evidence pointing toward X or Y or whatever it is that, if you're thinking the pattern's going to do this, that's when you want to take a look. Okay, do I have some momentum behind this move? Or do I have some volume coming into this move? Is this acting the way I've seen it act in the past? You want really to look at all the weight of all the evidence and not just make a decision, oh, that looks like a head and shoulders and it broke the neckline, I'm selling this thing. You want to take a look at all the evidence. And that doesn't preclude using fundamental analysis as well. Some people may use some fundamental analysis in the sense they may say, well, I know that the company had something bad happen, but they have this in place that's going to make up for that over time.
Great. I'm going to go back to the beginning when you were talking about emotions, investor emotions. And someone had asked, what are the investor emotions associated with resistance and support? In other words, why are they either selling or buying at these points?
Okay, that's a great question. I think the easiest way to think about that is look at it from a perspective of a buyer. And when we talk about support and resistance, let's say you're trading a stock and you buy it at $10. And a lot of people buy it at $10. And the price goes up to $15. But it turns around and it comes back to $10. Where do most people want to get out? They want to get out at that $10 level, right? Because that's where they bought it at. They saw it right up to $15, but they didn't get out at the time. Price came back down to 10. So now you're going to have all these people selling it there, so it's going to create this churning. But there's other people who wanted to buy it when it was at $10 before, but they didn't buy it, and they watched it go all the way up to 15. So now they're looking at it saying, wow, $10, it's a deal. I want to get in. So they start buying it. Now that creates your support at the $10 level, right? Now the stock goes back up to 15. People look at that and say, remember what happened the last time it got up to 15? It went right back down to 10. I bought it at 10. 15 is a great price. I'm going to sell it at 15. Now it has resistance because all those people that bought it at 10, they want to get out at 15 because they've seen what happened at 15 in the past. And now they want to take their $5 and run. And that's, I think, the easiest way to think about it. That's what's happening constantly. It's people getting in and out of their prices.